Most people give up millions of dollars just to feel like they're sleeping better at night with a safe portfolio. But what if I told you volatility isn't your enemy and not taking a little bit of risk might be your biggest financial mistake? Most investors, including me, do not like losing money. In fact, we have a term for this. It's called loss aversion. What loss aversion teaches us is essentially that for a dollar that we lose, most of us won't feel like we've come back to reality until $2 are made in return. Why is that? Most humans tend to feel like something is getting taken away. The way we know this is actually from a study that was conducted on monkeys years and years ago. The study was really simple. They took two sets of monkeys. The first group was a set that basically was given one apple. Monkeys, by the way, love apples. Despite you hearing that they love bananas, apples are actually their favorite. So they got one apple, and of course they were ecstatic, happy. They just kind of destroyed that apple, ate it really quickly. The second group of monkeys was given two apples, but before they could eat the second one, it was taken away. What emotion do you think that they felt? Do you think that they were ecstatic, happy? No. In fact, they were furious. So furious that they actually took their feces and started throwing it at the researchers. In many cases, investors are no different than that monkey. They think the same way. The stock market goes up and then it pulls back and they feel like something got taken away. And of course, that natural emotion is what we call loss aversion. And loss aversion can really work against you in the stock market. Every time somebody loses money in the stock market, they're more and more tempted to figure out, how do I get rid of that pain? Even if the market comes back, they want to avoid that feeling, that sinking feeling of, oh, I feel like I've just lost something. So what they naturally do is they start asking for what they call the safe portfolio. That's really just a myth. There is no such thing as a safe portfolio. And the costs to reducing volatility in the short term will kill your gains in the long term. Let's talk about three hypothetical portfolios. The first one is where you invest 100% of your money in the stock market. Now that can be depicted on our chart here. So the orange line essentially says, I've invested $100,000 in stocks 10 years ago, and that investment essentially grew from $100,000 to $340,000. Really impressive, a $240,000 profit. Now the line at the bottom is the polar opposite of that. That's investing in the bond market. Now, why would somebody invest in the bond market? Well, bonds are safer. They're less volatile. So they can actually reduce volatility in the short term quite a bit. If you look at that line is going to be depicted by the blue line. Investing $100,000 in the bond market would have essentially returned $17,000 over that 10-year period. If you look at that and you're anything like me, you're kind of like, wow, that is a lot less. In fact, it's 14 times less than what you would have gotten by just sticking with the stock market. And when you think about it and you look at the returns of that, that's a lot of return that you gave up. So let's say you decided, well, I'm going to do something kind of in the middle. I want the volatility profile of bonds, but I also want the maybe growth potential of stocks. Most financial advisors would say, hey, just mix them. You don't need to take all the risk of the stock market. It's perfectly fine to mix them. So here in the middle, the purple line is essentially one that's got 50% stocks and 50% bonds. Now that portfolio would have essentially doubled. It would have gone from $100,000 to about $205,000. You give up a lot of the return, but of course, is this going to reduce the volatility? In the last 10 years, there would have been 2 years that would have essentially been really volatile years, meaning you would have had significant ups and downs. The first one of those is 2018. Let's look at how these three portfolios fared in 2018. The all stock portfolio in 2018 would have lost about 4.4%. The all bond portfolio in 2018 would have actually made 0.10%. And then the 50-50 portfolio would have been somewhere in the middle at a loss of about 2.23%. So you reduced your volatility. A loss of 4% versus a loss of 2.3%. How much better did you sleep at night because of 2 percentage points? On $100,000, that's a $2,000 difference. Let's look at a second year. In 2022, we had a major market meltdown because of a perceived recession that never actually materialized. In the all stock portfolio, you would have lost 18% of your money in that year. That was actually the 5th worst year in history when it came to the stock market's performance. In the bond market, you would have also lost money, 12% that year. But again, not as much as the 18% in the stock market. And with the 50-50 portfolio, you would have been somewhere in the middle again, a 15% loss in a balanced portfolio. When we look at this and we say, oh, wow, I saved 3% in that year. Am I still better off just sucking it up and taking maybe a little bit more courage and saying, I'm going to go with an all stock portfolio rather than one that's a mixture of stocks and bonds? In my estimation, I think you should. I think this is the best kept secret in the financial services industry. Typically, most people outperform for one of two reasons. The first next one is they take on more risk. They're willing to accept more volatility. That's free. You don't have to pay extra for that. You don't have to do anything for that other than just say, I'm really going to check my emotions, understand that there's a negativity bias, and be okay with the idea that, hey, in the short term, I might fluctuate quite a bit more, but in the long term, if I stick with stocks, I'm going to make 14 times as much money as I would if I basically put all my money into bonds. Now, the second way that you outperform is by picking better investments, picking better stocks, picking better index funds, picking better mutual funds. That's hard to do. We work on that every single day here at Verde. And I can tell you, we spend a considerable amount of time with our investment committee doing research. When I look at our returns, especially for last year, most of the variability, most of the excess outperformance that our clients got was really related to them being more courageous. Meaning a client that said, I'm willing to take on more risk, outperformed significantly a client that said, no, I really want to play it safe and I want volatility reduction. Think about how a balanced portfolio could be costing you your gains, and think about the element of courage and how it plays into your overall performance and how much money you're going to have at the end if you choose to be more courageous versus if you choose to play it safe. But building wealth isn't just about returns. In the next video, I'll show you how to go from rich to wealthy and what freedom really looks like.